Welcome back. And any mention of the securitization of low-income housing is bound to raise a few eyebrows, especially after what we've seen in the subprime market. We have Kennedy Bungane in the studio with us now. He is the Director of Institutional and Corporate Banking at Standard Bank's Corporate Investment Banking Division. Kennedy, was it difficult to raise, to get investor interest for a securitization of low-income housing now?
Not at all, Jeff. The South African debt capital markets have, like all other capital markets, been affected by the credit risk and market risk concerns that have hit banks and financial institutions all around the world. However, we've got a good story to tell. We had great assets that we had assembled in our low-income housing space, and assets that people were looking for, investors were looking for. We could have distributed our securitization of Siyakha to more investors, but we're delighted with the three investors that we finally chose, and they were happy to receive them at the price that we gave it to.
That's 2.4 billion rand in securitized home loans. It's gone to a few companies as a way of helping out their financial sector charter requirements. How exactly does that work?
So when we launched the financial sector charter in 2003, there was this commitment to originate and finance low-income housing, also finance other sectors of the economy that, under apartheid and in the past had failed. You didn't have financial institutions investing in those or playing their role in them. One of these obviously was low-income housing. We committed to originate and finance over 42 billion rands of low-income housing, 32 billion rands to start with.
How much has been financed so far?
Standard Bank, over the last 4 years, we've financed over 10.7 billion rands of low-income housing.
And the rest of the industry, do we know?
The rest of industry is very close to meeting our 32 billion rand target and an additional 10 with a bit more assistance from government. But the trick about the deal we announced on Friday was that the other banks, which do not have a retail franchise, do not originate loans directly from the market, were worried about how they're going to fulfill this important transformational aspect of the charter. We committed back then that we'd originate much more than what was required of us and distribute to them. What has happened with the securitization transaction is that we've been able to package some of the home loans that we'd originated, package them in terms of the risk and reward structure that would make sense, and then have sold them to Investec, Liberty and Old Mutual, not only fulfilling our own commitments with respect to transformation in the financial sector charter, but also enabling other financial institutions to do so.
It does sound a little bit like what everybody was talking about when the subprime issue hit, though. And it is different given that the assets that you're securitizing theoretically are much more secure than a lot of the loans that were into those CDOs and that sort of thing. Is there any concern that this sort of securitization transaction might come back to bite?
Not at all, Jeff. The kind of assets we're talking about here are very different from the US subprime. Firstly, because they are performing assets. So it is not, home loans where the people aren't working, they're not repaying, and there are risks that, are similar to the subprime. Not at all. These are performing assets that we've incentivized new investors by making sure, for example, that the equity tranche in the structures that we've put together are sweet enough to enable for, if there's any unintended, and unforecasted problems in the repayments and whatever, that the investor actually has got enough equity tranche within there to continue getting their repayments as per the structure that we've put together in this securitization vehicle. So it is very different, really, from the subprime.
The first of its kind in the country, though. Are we likely to see more of these as we go along?
I would hope so. The message here is that low-income housing is a market that works. It works in the secondary market. It works as well for everybody, and everybody can actually play in this game. I'm hoping that despite the challenges that we have with respect to low-income housing, availability of stock and so forth, to give an interesting stat, Jeff, last year we had over 625,000 applications for new homes in South Africa in this segment of the market, and only 20,000 new houses were actually built and made available.
Why that gap?
There's a number of factors really playing at the same time here. The economy is booming. The construction sector is booming. As you might have gathered, both because of the 2010 World Cup and many other projects taking place in what is a fundamentally strong economy. There's been difficulty in getting enough new stock out there. This is one of the challenges that Standard Bank, in line with its commitment to transformation and the financial sector charter, has now stepped up to, by making sure in the kind of vehicle we've put together here that it's not just wait for houses to be built and for demand to arise and then step in to finance them, but also try and move into the supply side of low-income housing in making sure that we align our own resources in development, in buying property, and similar kind of initiatives which we shall make announcements of in the near future, and work with government, work with the builders, contractors to rise to this challenge. It is really the kind of challenge that the rest of the economy is faced with respect to capacity constraints, which are leading not just to significant demand from consumers, but from the corporate market as well.
I suppose that's the problem, though. You commit under the charter to a certain number of homes, a certain amount of loans granted, and that sort of thing, but there are not houses on the market to loan money into people that are buying them. There's a problem there.
There is a problem, but geez, we see it as a challenge that if we work together with other stakeholders and contributors in the value chain of delivering low-income housing, it's a challenge that we can sort out. Siyakha, as we've launched it on Friday, is evidence of how this can actually work, and we hope that all the other financial institutions and stakeholders to this market will continue to work with us for more of these to come in the future.
If we look at corporate banking in its entirety now, from a Standard Bank point of view, it is a major earnings contributor, but we're seeing a move now across the sector, or across the industry rather, to more focus on commercial banking and corporate banking as the retail side of things starts to get a little tougher.
It does. As a bank, we've got a very well diversified revenue stream. So, we do not really choose between personal, commercial, and corporate banking. We, are well represented in all of those markets. And yes, there is a bit of strain that's come through. The series of interest rate hikes that we've seen in the domestic economy are starting to bite, and it's slowing down a bit of demand. But I must emphasize, it's a slowdown of what is a fundamentally strong growth in the economy that is feeding itself through to the corporate market as well. The story around the impact of interest rates on consumers is well told, but little else, I think, is being told of the fundamentals of this economy being driven also by a very strong corporate base, with companies out there needing to raise their capacities to meet the challenge of orders, of business that is available. And we see this in the demand for corporate lines, for corporate activity that is out there. So South Africa is a long way from closing shop yet.
What's the pipeline for the corporate banking sector now going into 2008? What's the feeling at the corporate banking team, particularly now with the ICBC deal in the offing?
We're excited about the ICBC deal. It gives Standard Bank a lot of room to pursue the opportunities that we have. A significant portion of the ICBC transaction gives us direct capital, and that means we can follow through in the pipeline of facilities, of deals that we want to do with corporates. There's a positive vibe, despite the slowdown that is a direct result, really, of the change in monetary policy. We've got to remember that the significant capacity constraints in the economy in corporates has got to be addressed in one way or the other. Let me just give you an interesting stat. The capacity utilization measure of South Africa is at its highest at the moment at 87%, highest since it was measured. This is not only because corporates want to build more stadiums for 2010, It's, for much, much more than just the catalyst that has been the World Cup. In construction, in reverse banking, in the public sector, in retail, and all of the other sectors of the economy. The vibe for demand in terms of private sector credit extension is positive. And we are geared up as Standard Bank to meet that challenge and facilitate financial intermediation in corporate South Africa over the next 3 to 5 years.
Kennedy Bungane is the Director and Head of Institutional and Corporate Banking at Standard Bank's Corporate and Investment Banking Division. After the break, we'll bring you one of 2007's highlights here on Power Lunch. Don't miss it.